In this exam, you'll develop knowledge and understanding of the underlying principles and concepts relating to financial accounting. You'll also gain technical proficiency in the use of double entry accounting techniques, including the preparation of basic financial statements for single entities and simple groups, and be introduced to basic techniques of interpretation of financial statements. accaA recommends studying with an approved learning partner and using study materials from our approved content providers. However you study, accaA will support your learning journey with a range of free resources. There's study guidance to help you get started and support throughout your learning journey to get you exam ready. There is guidance from the examining team, including examiners' reports, which provide constructive and detailed feedback. There are technical articles, exam technique guidance, as well as videos and webinars to support your studies. The exam has 2 sections, both of which are compulsory. Section A consists of 35 objective test questions worth 2 marks each and covers a broad range of syllabus topics. The questions can take the form of multiple choice, multiple response, number entry or multiple response matching. Students should ensure they use the practice tests available on the accaA website to become familiar with these different styles of questions. Section B has 2 multitask questions worth 15 marks each, which test your understanding and application of financial accounting skills in more depth. Using the resources available from accaA and your approved learning partner is the proven route to exam success. So good luck with your financial accounting exam from everyone at accaA.
In this question, we are being asked to calculate a sole trader's net profit for a period. We can see from the alternative solutions that we have that none of them have revenue or costs to help us calculate this profit figure. And so we are going to need to rely on our accounting equation to help us work out the solution. If we look at our accounting equation, looking at assets minus liabilities is equal to capital plus profit minus drawings. We can use this to help us work out the profit figure. One thing we can see from the solutions that we've been given is that each of them includes capital introduced rather than the capital balance, and so therefore we're only looking at movements in our current year. We can also see that we've been given closing net assets and opening net assets as opposed to assets and liabilities. Therefore, to work out our assets minus liabilities part of our equation, we can take our closing net assets and deduct opening net assets. This will give us the movement in relation to assets and liabilities during the current year. If we look at our capital figure, this is on the right-hand side of the accounting equation. So if we move it over to the left-hand side to go alongside our assets and liabilities, where it was positive, it will now become negative. And so therefore we can deduct capital from these amounts. Our profit figure will stay on the same side, and so then we need to move our drawings over to the left-hand side. This is a negative figure on this side, and so therefore if we transfer it over, it will become positive. This means that we can now add it on. By completing this process, we now have all of our amounts apart from profit on the left-hand side, and so therefore closing net assets minus opening net assets minus capital plus drawings will give us our profit figure. Looking at the options available, we can see that the correct answer is the 4th option. In this question, you are being asked to decide which 2 of the following are differences between sole traders and limited liability companies. A sole trader is a business that is owned and operated by one individual, and there is no legal distinction between the owner and the business. Whereas with a limited liability company, it is owned and operated by different individuals, and it is a separate legal entity to its owners. Looking at the statements that we have to decide upon, the first one says that a sole trader's financial statements are private and a company's financial statements are sent to shareholders and may be publicly filed. This is a correct distinction. Our sole traders are effectively reporting the performance of their business to themselves, and there is no obligation to make their accounts public. The next statement says that only companies have capital invested into the business. This is not a correct distinction. All businesses will need some kind of capital injection at the very least. For our sole traders, it is referred to as capital, and for our companies, it's referred to as share capital. Our next statement says that a sole trader is fully and personally liable for any losses that the business might make. This is a correct distinction in comparison to a company where there is limited liability for the owners. For a sole trader, there is no legal distinction between the business and the owner, and so as a result, they are fully personally liable. Our final statement states that revaluations can be carried out in the financial statements of a company, but not in the financial statements of a sole trader. A sole trader does not have to follow the accounting standards as a company would. However, they can adopt the policies of a company. It is seen as best practice, even if there is no obligation. And so as a result, revaluations may take place within a sole trader's set of financial statements. And so reviewing this question and the two differences between sole traders and limited liability companies is our first and our third option. In this question, you are being asked which of the following statements is true. We have 4 statements to review, one of which is true, and all are relating to ratios. The first statement says that an entity's management will not assess an entity's performance using financial ratios. The aim of using financial ratios is to look at how efficiently and effectively a company is using its resources, and therefore this statement is not true. The next statement says that the analysis of financial statements using ratios provides useful information when compared with previous performance or industry averages. Ratios are often used to compare the current year with previous years and industry averages, and as a result, this statement is true. The next statement says that ratios based on historical data can predict the future performance of an entity. This cannot be done on its own. We can't just rely on historical data. There will be other factors, for example, what's going on in the industry as mentioned in the previous statement, and what's going on currently for the organisation. Our final statement says that the interpretation of an entity's financial statements using ratios is only useful for potential investors. There are far more users of the financial statements that will benefit from this interpretation. All potential users of financial information will benefit, for example, current investors, banks and potential lenders, and current and potential employees, just to name a few. And so by reviewing these statements, we can see that only one of them is true, which is our second option. In this question, you are being asked to decide what is the opening balance that should be included in the following period's trial balance for motor vehicles at cost on the 1st of July 20X6. You have been given the company's motor vehicle at cost account at the 30th of June 20X6. This motor vehicle asset account therefore runs from the 1st of July X5 through to the 30th of June X6. What we are looking for is what is the opening balance from the 1st of July 20X6, so what is going to be brought forward into the following year. We can see from the information provided in the ledger account that we had a balance brought forward at the beginning of the year, and then we had some additions on the debit side and a disposal on the credit side. And so therefore we have a balance carried forward at the end of the year, which would have been at the 30th of June 20x6. Therefore, to show the opening balance in the following year, we would then need to transfer that balance over onto the debit side and therefore show from the 1st of July the 36,750. This is an asset account. Assets are debits. We can see that the balance has been brought forward onto the debit side, and so therefore the correct answer is the fourth option, 36,750 on the debit side. In this question, we are being asked which two of the following items must be disclosed in the note to the financial statements for intangible assets. To answer this question correctly, you'll need to understand the requirements from IAS 38 and the disclosure requirements for an intangible asset. Remember that an intangible asset is an identifiable non-monetary asset without physical substance. It is classified as a non-current asset and it has a disclosure note. IAS 38 tells us that the disclosure requirements include the following: costs, amortization, which should include the methods and the expected period to be amortized, any impairments that will write down and reduce the intangible asset, and a reconciliation of the balance at the beginning of the year to the end. Looking at the four options to choose from, we have to decide how much detail is required to be disclosed regarding intangible assets. Looking at the first one, impairment losses written off intangible assets during the period is something that we would expect to see in the disclosure requirements for this asset. The second option, mentioning a description of the development projects that have been undertaken during the period, is something that we wouldn't need in the disclosure note. The organisation would hold this information, but it doesn't need to be communicated in the financial statements. The third option is that the useful lives of intangible assets capitalised in the financial statements should be included. This is something we would expect to see in our disclosure note, stating how long the intangible assets are going to be amortized. And then finally, the last statement is a list of all intangible assets purchased or developed in the period. This is the breakdown of the information that would be disclosed in the financial statements, and it is unnecessary to have that much detail included. Therefore, IAS 38 tells us that what's required for a disclosure note in the financial statements is the first option, impairment losses written off intangible assets during the period, and the third option, the useful lives of intangible assets capitalised in the financial statements. In this question, you are being asked which of the following statements are correct. The first statement is that capitalised development expenditure must be amortised over a period not exceeding 5 years. The second statement says that capital development costs are shown in the statement of financial position under the heading of non-current assets. And then the third statement is that if certain criteria are met, research expenditure must be recognised as an intangible asset. In order to answer this question, you will require your knowledge from IAS 38, the standard that gives us advice on intangible assets. The information given to us in the question relates to research and development costs. These costs are split between what's included as a non-current asset and what should be included as an expense in the statement of profit and loss. IAS 38 tells us that development expenditure should be included as a non-current asset if it meets the specific criteria of the standard. It should then be amortized over its expected life. The costs to be expensed include research costs plus any development costs that do not meet the criteria. Therefore, looking at the statements that we have to choose from, we can see that the first one, that capitalised development expenditure must be amortised over a period not exceeding 5 years, cannot possibly be accurate, because if our development expenditure needs to be amortised over its expected life, this could be longer than that time. The second statement, that capitalised development costs are shown in the statement of financial position under the heading of non-current assets. This is a correct statement. And then the final statement says that if certain criteria are met, research expenditure must be recognised as an intangible asset. Again, based on the requirements of IAS 38, we know that research costs should always be expensed, and therefore our answer must be the second option, statement number 2 only. In this question, you are being asked what amount should be charged to the statement of profit and loss in the year ended 30th of June 20X9 for electricity. In order to calculate this, they have given us Rashid's electricity expense ledger account for the year ended 30th of June 20X9. And we can see that we have a prepayment brought forward for $550, cash paid for $5,400, and then an accrual carried forward for $650. To help us visualize what's going on, we can plot these transactions onto a timeline. Our year end begins on the 1st of July 20X8 and ends on the 30th of June 20X9. The first transaction we are given is a prepayment brought forward. This must have been our closing prepayment at the end of the previous year, and so therefore would be released into the expense account this year at the beginning. The prepayment brought forward would have been a debit balance, and so therefore to release it, we would need to debit the electricity expense and credit prepayments to clear the balance. The next transaction that we look at is the cash paid for electricity during the year. This is the electricity expense that has been paid during the year, and so therefore the double entry would be to debit the electricity expense and credit cash or bank. The final transaction to review is the accrual carried forward. For there to be an accrual carried forward, there must have been some of the expense missing at the end of the year. And so therefore, if it was paid after the year end, we would need to bring it into our current year. To include the accrual, this would be a further increase to our expense account. And so we're going to debit our electricity and credit accruals. We can view these transactions in our electricity ledger account. Firstly, with the prepayment that was released, we said we would debit electricity with the $550. We then said that the cash paid would be included, and we would debit electricity again, this time with the $5,400. Finally, we would include the accrual for the end of the financial year, and we would include the $650 on the debit side. With all of our figures on the debit side, that total will come to $6,600. And so our transfer to the statement of profit and loss would be $6,600. And so to answer our question as to what amount should be charged to the statement of profit and loss for the year ended 30th of June, it should be our $6,600, which is the fourth option. In this question, you are being asked, what figure should appear in the statement of profit or loss for the year ended 30th of June 20X6 for these items? The items in question are in the text above. it tells us in the information provided that at the 30th of June 20X5, so 1 year before, a company's allowance for receivables was $39,000. This must be our balance brought forward for this year. It then gives us the trade receivables amount for the year, which totals $517,000. They then tell you that it's been decided to write off irrecoverable debts totaling $37,000, and then to adjust the allowance for the receivables to the equivalent of 5% of trade receivables. There is quite a lot going on within this information, and so it's a good idea to set out what we need to do. The first thing we should do is adjust for the receivables balance. Once we've done that, we are then in a position to be able to calculate the closing allowance for receivables balance at the 30th of June 20X6. Our third step will then be to make the adjustment to the allowance for receivables to ensure the closing balance is what we have calculated in our second step. So let's set up a working to adjust our receivables balance. We know from the question that the receivables amount is $517,000. They have also told us that it's been decided to write off irrecoverable debts totaling $37,000. So we will need to remove those from the receivables balance. This will then give us our adjusted receivables balance, which comes to $480,000. It's on this figure that we'll then be able to calculate our allowance for receivables. It tells us it should be the equivalent of 5% of the trade receivables balance. And so if we multiply by 5%, we will get our closing balance for the allowance for receivables, which amounts to $24,000. This is the closing balance for allowance for receivables, but it doesn't tell us what should be included in the statement of profit or loss. Let's look at the ledger account so we can see the movements. We will have an allowance for receivables account, which belongs in the statement of financial position, and we'll have an irrecoverable debts account, which belongs in the statement of profit and loss. We can see from the question that there was an opening balance for the allowance for receivables of $39,000. This would have been on the credit side. We were then told that there was a write-off of irrecoverable debts totaling the $37,000, which we've adjusted in our workings. The double entry for this would have been to debit the irrecoverable debts account and credit the receivables account. And so we will recognise that debit in our irrecoverable debts ledger account. We have then adjusted for the receivables balance, and we have calculated what the closing allowance for receivables is at 5%, which is $24,000. This will therefore be my carry forward balance in my allowance for receivables. What I need to do is work out what the adjustment should be for that balance to ensure that the ledger account agrees. For both sides to equal $39,000, my adjustment for allowance for receivables is $15,000. This adjustment will be a debit to the allowance for receivables account, and the other side is written off to the statement of profit and loss. And so I will show my credit balance in my irrecoverable debts account. The balancing figure in my irrecoverable debts account will be what we transfer to the statement of profit and loss. And so therefore my transfer is $22,000. And so finally, reviewing the question, what figure should appear in the statement of profit and loss for the year ended 30th of June 20X6? It should be $22,000. In this question, you are being asked to find the amount that Valley should report in its statement of financial position as accounts payable at the 30th of June 20X6. The information provided relates to the payables ledger and adjustments to the payables ledger and the purchase ledger control account. And so we are looking at a purchase ledger control account reconciliation. in order to find out our accounts payable balance. This will be recognizing that the balance per the purchase ledger control account will equal the balance on the purchase ledger when reconciled. The question tells us that the total of the list of balances in Valley's payables ledger was $438,900 at the 30th of June 20x6. This did not agree with Valley's payables ledger control account balance, and the following errors were discovered. We have not been given our purchase ledger control account balance, and so therefore we need to work with what's going on in the payables ledger in order to work out our balance. So our starting point will be the balance per the payables list, which equals $438,900. We then need to work through the errors and find out whether they relate to our list or whether they relate to the purchase ledger control account. In our first adjustment, it tells us that a contra entry of $980 was recorded in the payables ledger control account, but not in the payables ledger. So this relates to an error in our payables ledger and therefore affects our list. A contra entry arises when we have a customer and a supplier that is the same entity, and we are therefore adjusting or offsetting the balance from our sales ledger control account and the sales ledger and the purchase ledger control account and the purchase ledger. So we will always be reducing the balance with the $980. And so therefore, because it hasn't been updated in our payables ledger, we need to reduce our balance per the payables list. The next error tells us that the total of the purchase returns daybook was undercast by $1,000. The individual credit notes in the purchase returns daybook would have been updated in the payables ledger. However, the totals would have been updated in the general ledger, and so therefore this undercast relates to our purchase ledger control account and therefore does not affect our list. Our third error states that an invoice for 4344 was posted to the supplier's account as 4434. So here we have a transpositional error. The difference between these two amounts is $90, and we can see what was posted to the supplier's account was bigger than what should have been posted as per the invoice value. And so therefore we're going to need to reduce our payables list for this invoice error. With our adjustments now identified and updated on the list, we can now total this up and calculate our revised payables list balance. This amounts to $437,830. Based on the assumption that all of the errors have been found and updated, our balance per our purchase ledger will equal our balance per the purchase ledger control account in the general ledger. This is the balance that is included in the statement of financial position, and so therefore our revised payables ledger balance of $437,830 must equal our purchase ledger control account balance. And so therefore, looking at the options available to us, our correct answer is the first option. In this question, we are being asked to decide which two of the following costs should be included in valuing the inventories of a manufacturing company. In order to do this, we will need to be able to remember the requirements of valuation as per IAS 2 inventories, and more specifically, what can be included for a manufacturing company. According to the rules as per IAS 2, the cost of inventory can include the following. They are permitted to include the purchase cost, the cost of conversion, and other costs that will bring the inventory to its present location and condition. Costs of conversion can include direct costs relating to the inventory and also production overheads, such as depreciation on machinery and buildings. We can see from the options given to us that the first one, carriage inwards, relates to delivery costs for goods coming in, and so therefore would apply to other costs to bring inventory to its present location and condition. Carriage outwards relates to delivery costs going out relating to revenue, and so would not be allowed as per the inventory cost. Depreciation on factory machinery would apply to the cost of conversion and so therefore would be allowed. And general administrative overheads are not permitted as per IAS 2. And so then in deciding which two of the following costs should be included in the valuation as per IAS 2, we should include the first option, carriage inwards, and the third option, depreciation of factory machinery. In this question, you are being asked to decide which of the following explains the imprest system of operating petty cash. Our imprest system is the method of paying out and replenishing the petty cash system. One of its aims is to avoid excessive levels of cash within the business. So how does the imprest system work? Petty cash will be stored within a business. There will be a fixed float of cash that is kept in the petty cash tin. Then, as the business incurs expenditure, that money will be paid out. The books and records will be updated regularly for the movements with the petty cash tin, but what's significant about our imprest system is that the petty cash will be reimbursed at regular intervals for the expenses that have been paid out. So for example, if we had petty cash and we had an imprest system with a fixed float of, let's say, $200, and within the period the expenses paid out of that petty cash were $50, then the expectation is that the $50 will then be reimbursed back into petty cash. So looking at the options we have available to us for our answer, the second option is what directly links to the explanation in this diagram. And so therefore it is the exact amount of expenditure that's reimbursed at intervals to maintain a fixed float that is the correct answer. In this question, you are being asked to calculate Prisha's gross profit for the year. Prisha is a sole trader and has not kept accurate accounting records during the financial year. She had opening inventory of $6,700, purchased goods of $84,000, and then at the end of the year, she had $5,400 left in inventory. They also tell us that sales are made at markup on cost at 20%. Based on the information provided to us, we are looking at the relationship between our sales, cost of sales, and gross profit. We have been given information relating to our cost of sales. They've told us that the opening inventory is $6,700. The purchases, so purchased goods, cost $84,000, and closing inventory was $5,400. In order to calculate cost of sales, we take our opening inventory plus purchases and then deduct closing inventory. Our cost of sales figure therefore equals $85,300. We need to get to our gross profit figure, but how do we find that when our sales figure is missing? The additional information they have given us is that sales are made at a markup on cost of 20%. And so therefore, working on cost of sales being 100%, sales must be 120%, which would then leave us with gross profit of 20%. If our cost of sales figure is 100%, we can now work out what our gross profit will be. If we take our cost of sales figure at $85,300 and multiply by 20%, this will give us our gross profit figure. This equals $17,060. We only need to find our gross profit figure, and so the correct answer is $17,060. In this question, you are being asked to decide which of the following should appear in the company's statement of changes in equity. The company's statement of changes in equity will represent the owner's interests in the company. This will include the share capital, share premium, and reserves, which are usually the revaluation surplus and retained earnings. Looking at the three options we have, the first one is to look at total comprehensive income for the year. Our total comprehensive income for the year is calculated in the statement of profit and loss. It is then transferred to our retained earnings before decisions are made in how this is distributed to the shareholders. Our second option is looking at amortization of capitalized development costs. Amortization is recognised as an expense in the statement of profit and loss. The other side of this reduces the intangible asset in the statement of financial position and so has no impact on the statement of changes in equity. Our third option is looking at the surplus on revaluation of non-current assets. A surplus on revaluation is where the asset value has increased, and so therefore you would debit the asset account. No money has been received and this gain is not realised, so we cannot recognise it as profit. The other side would be a credit to the revaluation surplus, and so the surplus on revaluation would be recognised in the statement of changes in equity. And so to answer this question, which should appear in the statement of changes in equity, we can see that the first and the third will be included, and so the correct answer is the first option. In this question, we are being asked, what is Hassanco's return on capital employed? Return on capital employed looks at how much profit is generated from capital invested, and this can be calculated using the following ratio. We take our profit before interest and tax and divide by the company's capital employed, which is expressed as a percentage. To work out the capital employed, there are a couple of options. One is to use the shareholder equity plus non-current liabilities. Alternatively, you can take total assets minus current liabilities. The information provided doesn't include total assets and current liabilities, and so we'll use this option instead. Calculating Hassan's return on capital employed, we can see that the profit before interest and tax is 10,200. We need to divide this by the shareholder equity and non-current liabilities. The bottom half of our calculations given to us, we can see that we've got share capital and other components plus the loan liability repayable in 20x9. And so as a result, this 42,500 is our capital employed. This calculation expressed as a percentage will then equal 24%. And so Hassan's return on capital employed is 24%. In this question, you are being asked to decide whether the following statements about sales tax are true or false. For a company that is registered for sales tax, they will charge sales tax on their outputs, and they can reclaim sales tax on their inputs. The first statement says that sales tax is an expense to the ultimate consumer of the goods purchased. For an entity that is registered for sales tax, they are able to reclaim the sales tax on their purchases, and so therefore it is not an expense to the company. However, for a consumer that would purchase from this organisation, they are not registered for sales tax, and as a result they will not be allowed to reclaim the sales tax on their purchases. They therefore suffer the cost of the sales tax as part of the purchase, and this means that this statement is true. The second statement says that sales tax is recorded as income in the accounts of the entity selling the goods. For this statement, we're going to need to think about the double entry that happens when a sale is recorded. For an entity that has made a sale and is registered for sales tax, there will be three amounts. There will be the total sale amount, which is the gross, there will be the sales tax, and there will be the net sales. The total is what's due from the customer, and so therefore we would either debit receivables if the sale was on credit, or we would debit cash. The sales tax is what has been collected, and so it needs to be recorded as a liability to be paid over at a later date, and so we would credit the sales tax account. The net figure is the true sale, and we would record this as a credit to the sales account. By looking at this double entry, we can see that the income is recorded net of sales tax. And so the sales tax is not recorded as income, it's recorded as a liability. This statement is false. In this question, you are being asked to decide which of the errors will require an entry to the suspense account to correct them. In the information provided, it tells you that the trial balance failed to agree and that they created a suspense account for the difference. They don't keep control accounts, and then 4 errors are given for us to decide whether there is an impact on the suspense account. Looking at the first error, they tell us that in recording an issue of shares at par, cash received of $333,000 was credited to the ordinary share capital account as $330,000. We therefore have a difference on our share capital account. What should be there is $333,000, but what's been posted is $330,000. And so we have a difference of $3,000. The assumption is that the debit side of this transaction was recorded correctly, and so that there was a debit to cash for $333,000 and then just the credit to the share capital. Therefore, to correct this, we need to make the share capital balance bigger. And so to increase our share capital balance, we will need to credit share capital with the $3,000, and the other side of this transaction will go to the suspense account. In our second error, they tell us that cash of $2,800 paid for plant repairs was correctly accounted for in the cash book, but was credited to the plant asset account. So therefore what they have done is to credit the cash account and to credit the plant asset account. What should have happened, as it is a repair, would have been to debit the repairs expense account and credit cash. We therefore need to do 2 things. We need to remove the balance from the plant asset account, and we also need to put it in the repairs account on the correct side. So we will need to debit the plant asset account to remove the balance for $2,800. We will then need to debit the repairs account for $2,800, and the other side to correct will be to credit the suspense account with $5,600. Our third error tells us that the petty cash book balance of $500 has been omitted from the trial balance. If we have the omission of an entire balance, then this will result in a suspense account balance. Our petty cash account is on the debit side, and so to correct this, we would need to show petty cash on the debit side for $500. The other side will then be to include the balance in the suspense account, which is a credit of $500. Our final error tells us that a check for $78,400 paid for the purchase of a motor car and was correctly accounted for in the bank, but was debited to motor vehicles as $87,400. So here we have a transpositional number, and the difference between the two figures is $9,000. The bank account side was correctly accounted for, and so it's only the debit to the motor vehicles account which needs to be corrected. Therefore, to adjust for this error, we will need to reduce the motor vehicles account by $9,000. So we're going to credit motor vehicles, and then the other side is a debit to the suspense account. Reviewing our question again, we needed to decide which of the errors will require an entry to the suspense account to correct them. And we can see that the first, second, third, and fourth entry all require an entry to the suspense account. Therefore, the correct answer is the third option. In this question, you are being asked which of the following is the correct accounting treatment for the claim in the financial statements for the year ended 31st of July 20X9. The claim in question is for $100,000 from a supplier for providing poor quality goods which had damaged the supplier's plant and equipment. This claim was prior to the financial year ended 31st of July 20X9. They also tell us that there's a 20% chance that Canon will successfully defend the claim. What this means is actually there's an 80% chance that they will lose, making it probable that there will be an outflow of resources. IAS 37, which looks at provisions, contingent liabilities and assets, tells us that there should be a provision if there is an obligation due to a past event, if there is a probable outflow of resources, and a reliable estimate. Looking at the information provided, we can see that the claim was before the year end, and the $100,000 is probable. With this in mind, it looks likely that the amounts will have to be paid by the company, and so Canon should make a provision in their financial statements. And therefore, answering this question, we should select the first option. Canon Co. should provide for the expected cost of the claim of $100,000. In this question, you are being asked how much should Gareth capitalise as a non-current asset in relation to the purchase. The information provided to us tells us that Gareth is a sales tax registered trader and has purchased a computer for use in his business, and the invoice for the computer showed the following costs. Looking at the breakdown of these costs, we need to decide what is allowed as per IAS 16. Our accounting standard for property, plant and equipment. The initial measurement of cost should include all costs to bring the asset to its working condition and location. For the computer to be available for its intended use, the initial cost of the computer will be allowed, along with the additional memory costs. The delivery costs will also be allowed because that brings the computer to its location, as well as the installation costs. Maintenance costs are not allowed and they should be expensed. In addition to this, Gareth is a sales tax registered trader, and so the sales tax will be reclaimed and not included as part of our asset cost. Therefore, the first four items should be capitalised, and these amount to $1,015. Therefore, in answering the question, how much should Gareth capitalise as a non-current asset in relation to the purchase, it should be $1,015. In this question, we are being asked what should be the correct balance per the cash book. In order for us to find this cash book balance, we have been given a bank reconciliation in the information provided, and we're told that it has been prepared by a trainee accountant. Looking at the bank reconciliation that has been prepared, I can see that there are addition errors, in particular looking at the top half. And so I'm going to prepare a revised bank reconciliation. Working through each of these numbers, the first number we have is the overdraft as per the bank statement. This amounts to $3,860, but as it's an overdraft, it should be a negative balance. What we would then do is deduct the unpresented checks for $9,160. When these clear the bank account, they will reduce the bank account further, and so I'm also going to express them as a negative number. Revising this balance then, the subtotal at this point will be 13,020, also shown as a negative figure. The next step will be to add the outstanding lodgements. These uncleared receipts will increase my bank account, so 16,690, and so adding these onto the 13,020 as a negative figure will give me a revised cash at bank amounting to 3,670. This cash at bank balance is my balance as per the cash book. And so looking at the options available, we can see that the correct answer is the first option. In this question, you are being asked to decide which of the following statements are true about limited liability companies. Looking at these statements individually, the first one says that the company exposure to debt and liability is limited. This is not true. The only limited liability is with the shareholders of the organisation. The company itself will be liable for all of the debts and liabilities of the company. So shareholders have limited liability, but not the company itself. The second statement is that the financial statements must be produced. This is true. There is a statutory obligation for all companies to produce financial statements for their users. In addition to this, these financial statements should also be audited. The third statement is that a company continues to exist regardless of the identity of its owners. Again, this is true. This refers to the separate entity principle, and a limited company is incorporated so that it is a separate legal entity to its owners. So by reviewing these statements, we can see that the second and the third statement are true. And looking at the options for our answers provided, we can see that our second option, 2 and 3 only, is the correct answer. In this question, we are being asked which two of the following are characteristics that are required to ensure faithful representation. Faithful representation is one of the IASB's fundamental qualitative characteristics. There are two. One is faithful representation and the other is relevance. We are told from the conceptual framework that for financial information to hold faithful representation, it should possess the following characteristics. We have completeness, neutrality, free from error, comparability, verifiability, timeliness, and understandability. When answering this question to decide which two of the following characteristics are required to ensure faithful representation, we can see that our second and our fourth options match two of the characteristics in our list. Accruals and going concern are not characteristics as they are accounting concepts which underpin the preparation of the financial statements. In this question, you are being asked to decide what should the closing balance be when all of the errors made in preparing the receivables ledger control account have been corrected. A receivables ledger control account has been provided for you. However, some of the balances included are incorrect. I'm therefore going to prepare a revised receivables ledger control account in order to calculate the correct balance. Looking at the individual amounts, the first item we have is the opening balance. A receivables ledger control account should have a debit balance, and so therefore this is a correct item and I can put it straight into my T account. They have also included the credit sales on the debit side. An increase in credit sales would be a debit to my receivables ledger control account and a credit to income. The next item they've included is cash sales. However, cash sales should not be here. This would be a debit to the bank account and then a credit to sales, and therefore has no impact on our receivables ledger control account. The final item on the debit side is a contra. Contra entries are there to offset balances between the receivables ledger control account and the payables ledger control account. Therefore, this figure should actually be on the credit side. Our contra entry balance is always to debit the purchase ledger control account and credit the receivables ledger control account. And so I will include it on the credit side. Over on the credit side, I can see we've got cash received from credit customers. This is a correct balance. There would be a credit to my receivables ledger control account and a debit to bank. The next item is interest charged on overdue accounts. This is interest that's charged to the customers, and so it would be an additional amount received from our credit customers. Therefore, it should actually increase our receivables ledger control account, and this amount should be included over on the debit side. And so I will correct this on my revised ledger account. The next item is my irrecoverable debts written off. This would be a debit to the expense account and then a credit to the receivables ledger control account. And so it's correct, and I will just update my ledger account. The final item that we've got in this receivables ledger control account is my allowance for receivables. This should not be included in this account. It has its own account, allowance for receivables, where it should be shown on the credit side, and so therefore should be removed. With all of the entries now in the correct place, I will then revise my account balance, and my balancing figure or my closing balance is now $307,100. Looking at my options available to answer, I can see that the correct answer is my second option. In this question, you are being asked to decide whether the following material events that have occurred after the reporting date and before the financial statements are approved are adjusting events. In order to answer this question correctly, you will need to draw your knowledge from the accounting standard IAS 10, which looks at events after the reporting period. This standard gives us advice on whether something should be adjusting or non-adjusting. For an item to be adjusting, it should be material and the condition should have existed at the reporting date. For an item to be non-adjusting, again it should be material, but this relates to events where the condition did not exist at the reporting date. We need to identify whether they are adjusting events, and so we are looking for evidence of whether the condition existed at the reporting date. Looking at these events individually, the first one is where there is a valuation of property and there's providing evidence of impairment in value at the reporting date. We can see that there is evidence that this was at the reporting date, and so yes, it should be an adjusting event. The next statement says that a sale of inventory held at the reporting date is for less than cost. Inventory should be valued at the lower of cost and net realisable value, and so if we have got a sale of inventory that's less than cost, that would suggest the inventory is overstated and should be an adjusting event. The next statement says that there was a discovery of fraud or error affecting the financial statements. If there has been an impact on the financial statements, then the condition must have existed at the reporting date and so should be adjusting. Finally, there was the insolvency of a customer with a debt owing at the reporting date which is still outstanding. If the balance was owed at the reporting date and they are unable to pay, to leave that balance in the financial statements would mean that the receivables balance is overstated. The receivables balance should be adjusted to remove the debt that cannot be paid. the condition existed at the reporting date, and so we have an adjusting event. Therefore, all 4 statements are adjusting events in accordance with IAS 10. In this question, you are being asked to find the value of the company's closing inventory of engines at the 30th of April 20x6. The information provided tells you that they value the inventory of engines using the FIFO, first in, first out method. They tell us how many engines they had at the beginning of the year. So on the 1st of May 20x5, they had 700 engines in inventory that were valued at $190 each. They then show us the transactions during the year, taking us up to the 30th of April 20x6. In order to be able to work out the closing inventory at the 30th of April 20x6, we should work through the information chronologically to look at the movements of purchases and sales of inventory throughout the year. For this, I will set up a working. For each movement in inventory, I will look at the number of items that they have, the value, and the total. Starting at the beginning of the year, they told us on the 1st of May they had 700 engines in inventory valued at $190 each. Therefore, the value of that inventory would have been the 700 multiplied by the 190, which gives us $133,000. They then tell us on the 1st of July they purchased some more engines, and they purchased 500 at $220 each. And so I will add those to my working. The next transaction is on the 1st of November, where they sold some of the engines and they got rid of 400 engines for $160,000. What we're interested in is the number of engines that they have sold, because this is what's been removed from our inventory. We know we are using first in, first out, and so when selling these engines, they would have removed the earlier stock. Therefore, the 700 that we had at the beginning of the year, we're going to take 400 from. This will leave us with 300 engines left, and we'll be using the value of $190. Therefore, putting that in my working, on the 1st of November, I've sold 400 engines. I'm using the 190, and so the total removed is $76,000. My next transaction is on the 1st of February. We have purchased some engines, and this time we've got 300 engines purchased at $230 each. I am adding these goods to my inventory, and so I'm going to put on the 1st of February x6, 300 engines, $230 each, and this will total $69,000. Finally, the last transaction is on the 15th of April. They've made a sale and they've sold 250 engines for $125,000. Again, what we're concerned about is how many of those engines have been removed. We've got 250 engines removed from inventory. Using the FIFO method, we would take the earlier inventory first. We can see our opening inventory, there were 300 engines at $190. And so we're going to remove 250 from that batch. That will then leave us with 50 left there. And so on the 15th of April, x6, we've now sold 250. Cost is 190. And so the total value of cost will be $47,500. In order to work out our closing inventory, we will then add up this list, taking our opening inventory, the additions, and taking off the sales throughout the year, and that will leave us with a value at the end of the year of $188,500. Looking at the options that we have available to answer, we can see that our second option is the correct answer. In this question, you are being asked to find Amy's profit for the year ended 31st of December 20x8. Looking at the information that you've been provided with, we can see we have got assets, liabilities, and capital. And so we're looking at the relationship between these three items and looking at our accounting equation. A reminder of the accounting equation: assets minus liabilities is equal to capital plus profit minus drawings. We are told in the question that Amy is a sole trader and has assets of $569,400 and liabilities of $412,840 on the 1st of January 20x8. This is the only opening information we've been given, and so we need to use that to help us find our opening balance for capital. Looking at our accounting equation, if we take the assets, which are $569,400, and deduct the liabilities of $412,840, this will equal $156,560. Therefore, assets minus liabilities must equal opening capital, and capital must be $156,560. Now we have our opening capital figure, we can then look at the rest of the information that's been provided. It tells us that during the year, the 31st of December 20x8, she paid $65,000 capital into the business, and she paid herself wages of $800 per month. Therefore, if we add the $65,000 capital paid into the business during the year, we will then get closing capital of $221,560. The other figure we were given were the wages of $800 per month. This will be used to calculate our drawings figure. And so therefore, if we've got $800 per month multiplied by 12 months, that will give us drawings of $9,600. The remaining information given to us relates to the end of the year on the 31st of December. They tell us that Amy had assets of $614,130 and liabilities of $369,770. We now have our closing assets and liabilities, and we have our closing capital and drawings. And as a result, we can use the accounting equation to find the profit figure. Therefore, looking at our accounting equation, the closing assets and liabilities were $614,130 minus $369,770. Therefore, the left-hand side of our equation equals $244,360. The right-hand side of our equation has to equal the same. So far, our capital is $221,560, and we would deduct the drawings that we've calculated at $9,600. This will equal $211,960, and therefore our balancing figure to ensure that the right-hand side equals the left-hand side must be $32,400. This figure represents our profit, and so when answering the question, what is Amy's profit for the year ended 31st of December 20x8, it is $32,400. In this question, you are being asked which of the following could explain the imbalance. The imbalance that they are talking about is that Bumbly has extracted the trial balance for the year ended 31st of December 20x7, and the total of the debits exceeded the credits by $300. Therefore, what we're saying is in our trial balance with our debit and our credit balance, we have got an extra $300 on the debit side in comparison to the credit side. Looking at the options available to us, the first one tells us that irrecoverable debts of $150 were credited to receivables. When adjusting for an irrecoverable debt, we are going to debit our irrecoverable debts account and credit our receivables account. And so it's perfectly fine to have credited that account, and this will have no impact on our imbalance. The next one says that sales of $300 were omitted from the sales daybook. If they were not included in the sales daybook, then it means the entire transaction didn't happen. If this transaction had been included, it would be a debit to the receivables account, potentially a credit to sales tax, and a credit to revenue, and so would have no impact on the imbalance. The next issue is looking at discounts received. They told us that discounts received of $150 was extracted to the debit column of the trial balance. Discounts received arises when a credit purchase is paid for promptly. They will therefore pay less than the invoice value. In order to deal with a discounts received, you would debit the payables control account and credit the discounts received account. The discounts received balance should be on the credit side, and here it's been extracted on the debit side. Therefore, visualizing what's going on here, it would have been put on the debit side in the trial balance. In order to remove it, we will need to credit to eliminate the balance and then put it in on the credit side. Therefore, this does explain the imbalance on our trial balance. The final issue is looking at the bank ledger account and the fact that it did not agree with the bank statement by a debit of $300. This is looking at the relationship between the bank ledger account or our cash book and the bank statement. These may very well not agree due to timing issues, and this is all dealt with in a bank reconciliation. As a result, it will not have any impact on the imbalance relating to the trial balance. Therefore, reviewing our options and deciding which of the following could explain the imbalance, the correct answer is the third option. For this question, we have been given two tasks. We are given some background information relating to two companies. We have Keswick, who has bought shares in Derwent on the 1st of June 20X5, and so therefore we have a consolidated group accounts question. Task 1 asks us to use this information to complete the following financial statement. We've got revenue and cost of sales and profits, and so therefore we are looking at a consolidated statement of profit and loss. Then for task 2, we are then asked to decide, does the existence of any of these factors illustrate the existence of a parent-subsidiary relationship? This is independent of the background information and task 1. Firstly, let's look at the background information that relates to task 1. We can see that Keswick acquired 80% of the share capital of Derwent on the 1st of June 20X5. Keswick owns more than 50% of the shares of Derwent and so is the parent company, and Derwent is therefore the subsidiary company. In this situation, when we have a group, we will need to prepare consolidated financial statements. For many of the balances we prepare in consolidated accounts, we will be adding together Keswick's figures to Derwent's figures. However, there will be some adjustments that we need to make to these numbers. Looking at task 1, we needed to use the information to complete the following financial statement. The first thing that we have to do is, looking at the drop-down menu, decide the title. We know we are looking at a consolidated statement of profit and loss, and for any profit and loss we're looking at the performance for the year, and so therefore it's consolidated statement of profit and loss for the year ended 31st of May 20X6. The next step is to look at each of the individual balances line by line and decide what needs to be included. So first of all, for our revenue figure, we can see that the revenue for Keswick was 8.4 million. Added to this would be the revenue for Derwent, which amounts to 3.2 million. What we're also told in the information just underneath is that during the year, Keswick sold goods costing 1 million to Derwent for 1.5 million. Any intra-group purchases and sales made are not allowed to be included in consolidated accounts. Basically, we are not allowed to sell to ourselves, and so we will need to remove the sale of these goods from Keswick's figures. And so therefore we are going to need to adjust and reduce these balances by 1.5 million. This will then give us the adjusted figures of 10,100,000. Looking at our drop-down menu for our consolidated statement of profit and loss, the revenue figure to include will be the 8.4 million plus the 3.2 million and then deducting the intragroup sale of 1.5 million. The next balance to prepare is our cost of sales figure. Once again, looking at the information provided, we can see that Keswick's cost of sales were 4.6 million. Adding on to this is Derwent's, which amounted to 1.7 million. Remembering that we had an intragroup sale, and so Keswick sold to Derwent, and so therefore Derwent purchased from Keswick. The purchase in Derwent's accounts needs to be removed. So we are going to remove the 1.5 million that they paid for those goods. In addition to this, we are also told at the end of the year on the 31st of May, 30% of these goods remained in Derwent's inventory. When Keswick made a sale to Derwent, they made a profit. They bought the goods for 1 million and then sold the goods for 1.5 million. They have therefore made a profit of 500,000. In the consolidated accounts, we are not allowed to recognise any unrealised profit. 30% of these goods are still in inventory and so therefore they are unrealised. We will therefore need to remove the profit that remains in inventory. So we need to take that 500,000 and multiply by 30%, and so the unrealised profit in inventory is 150,000. This will be sitting in our closing inventory balance, and so therefore we will need to add this back to our cost of sales figure. So I'm going to also add the 150,000, and so the consolidated cost of sales figure would be 4,950,000. Looking at the drop-down menu then for cost of sales, the correct option is going to be the second option. My next box is to calculate the gross profit. This is going to be based on my figures, so therefore I've got my revenue figure of $10,100,000 and then taking off cost of sales, which is 4,950,000, will give me a gross profit of 5,150,000. And so I'll just type that into my box. The next box to calculate is for distribution costs. Looking at the figures that we've been given, distribution costs for Keswick are 1.5 million. Adding on the distribution costs for Derwent are 510,000. There are no further adjustments, and so therefore we have a figure of 2,010,000. With this figure now calculated, I can include that in the box provided. The next one is for my admin expenses. Looking at the information that I have been given, I can see that Keswick has admin expenses of 700,000 and Derwent has 450,000. Therefore, the total admin expenses for the consolidated accounts are 1,150,000. With that calculated, I can then add that to my correct box. This will then give me a profit before tax figure, which comes to 1,990,000. Adding that to my box. The next step is to add the tax figure. From the information provided, we can see that the tax for Keswick is 600,000 and the tax for Derwent is 140. And so therefore we have got 740, which needs to be included in the box provided. This then brings us down to the profit for the year. So taking my profit before tax, removing the tax, and therefore we are left with 1,250,000. Again, adding that to the box provided. Looking at the remaining information to complete for task 1, we can see that we need to look at what's attributable to. Keswick only bought 80% of the shares in Derwent. And so when looking at this drop-down menu, we are selecting the group profit for the year minus the non-controlling interest. The controlling interest is 80%. However, there is 20% of shares belonging to other parties. The final box to complete for task 1 is to actually calculate the non-controlling interest. In order to do this, we need to look at the information relating to Derwent. Derwent's profit for the year is 400,000. Remember that only 80% of the shares are owned by Keswick, and so therefore not all of that profit belongs to the group. We therefore need to calculate the non-controlling interest. If we take our profit figure and multiply by the non-controlling interest percentage of 20%, this will give us 80,000. This therefore needs to be included in the final box, like so. We can see from task 1 that we've got all of the elements correct and everything is completed. Let us now look at task 2. So we needed to decide, does the existence of each of the following factors illustrate the existence of a parent-subsidiary relationship? The first one is having greater than 50% of the equity shares being held by an investor. Greater than 50% does indicate the existence of a parent-subsidiary relationship. Having significant influence does not indicate control and so therefore would not illustrate the existence of a parent subsidiary. Looking at 50% of all shares and debt being held by an investor, only having greater than 50% of equity shares would indicate a parent subsidiary, and so the answer for this one is a no. The next one looks at greater than 50% of preference shares being held by an investor. Preference shares are non-equity. Ownership interest is characterised by ordinary shares and voting rights, and so therefore this would not indicate a parent subsidiary. The next one, looking at control, having control would indicate a parent subsidiary relationship. Non-controlling interest of 10% means that there would be a controlling interest of 90%, which would indicate a parent subsidiary. Having greater than 50% of preference shares and debt being held by an investor, once again, looks at non-equity shares and debt, and so therefore would not have an impact on a parent subsidiary. So the answer is no. The final one, looking at 100% of the equity shares being held by an investor, equity shares are an indicator of a parent subsidiary, and having 100% would mean that yes, we do have that relationship. Therefore, reviewing our answers, we can see in the top right-hand side that we've got all of our marks and answered each of the elements for task 2.
In this question, you have multitask requirements, all of which are testing topics that surround the preparation of year-end financial statements. The background information reveals that Malwright Co. has an accounting year-end of 31st October and that the accountant is preparing the financial statements as at 31st October 20X7. Your very first task is to think about the list of items that have been presented in the trial balance and to establish whether they belong on the statement of financial position for the year end 31st October X7. So let's start from the top of the list. Buildings at cost would be included. The accumulated depreciation, if you note the date, is the information at the start of the year. And when we show the balance of our buildings at year end, it will be the accumulated depreciation at the end of the year that would appear. So here we're going to select no. Plant at cost is a non-current asset, would appear in the SOFP. Just like with the accumulated depreciation for the buildings, here again you see that the plant accumulated depreciation is the balance at the start of the year. We're interested in the balance at the end of the year, so here from the drop down we would select no. Bank balance is a current asset and so would appear in the SOFP. Revenue, however, is an income and would appear in the statement of profit or loss, so we're going to select no. Net purchases is an expense, so we're going to select no. Inventory at the start of the year is opening inventory, which is part of cost of sales, and so again, we're going to select no from the drop down. Cash is a current asset and would appear in the SOFP. Trade payables is a liability, would appear in the SOFP. The trade receivables is a current asset and it would appear in the SOFP, so we select yes. The administrative expenses is a cost and therefore would appear in the statement of profit or loss. So we're going to select no here. The allowance for receivables at the start of the year is not going to appear in the SOFP at year end. We want the year end figure, so we're going to select no here. In a similar manner, the retained earnings at the start of the year would also not appear. It's the retained earnings at the end of the year that we are interested in. The share capital is going to appear in our SOFP within the equity section, and the share premium account would also appear in the SOFP. And as you can see, we've answered all of these options correctly, which means we can move on to task 2. In this particular task, you are being asked to calculate the allowance for receivables that's going to be increased to 5% of the trade receivables, as well as think about the double entries that would appear. Now, to attempt a question like this, I would encourage that you think about the calculation of the allowance for receivables at year end. What do we know? Well, we know by looking at the trial balance that the trade receivables at year end amounts to 320,000. So if we start with trade receivables of 320,000, we can take 5% of that to give us the balance of the allowance for receivables at year end, and 5% of this amounts to 16,000. We can also see from the trial balance that the allowance for receivables at the start of the year is an amount of 10,000. What we want to do is increase this so that at the end of the year, or the carry forward allowance, equates to 16,000. And so we can see that this is an increase of 6,000. Whenever you increase an allowance for receivables, you are debiting an expense and crediting the allowance for receivables. With that in mind, if we go into task 2, we can attempt the first part. They're asking for the year-end journal for the allowance, and we need to select from the drop-down menu. For trade receivables, there is no implication because of this allowance. Remember, the allowance for receivables is a separate ledger entry, so there is no credit or debit to post. We're told in this question that the allowance for receivables is to be treated as an administrative expense. Therefore, the admin expenses or the administrative expenses will be debited. The allowance for receivables is being increased. Now, this allowance for receivables is an entry that's a reduction to a receivable account. Receivables are typically on the debit, so to reduce them, we would credit, and so the allowance for receivables balance is going to be a credit entry. There is no implication on revenue, so we can select that there's no debit or credit to post to revenue. Finally, we need to complete the following, which is the amount to include in the statement of profit or loss after the allowance is increased to 5%. We've already calculated this as 6,000, so we can type in the 6. Bear in mind you're already given the thousands there, so simply type in the 6 and you can move on. And again, you can see that we've attempted all parts of this question correctly. Moving on to task 3 then, here we're being asked to think about depreciation. So it says that plant is depreciated at 20% per annum using the reducing balance method, and that buildings are depreciated at 5% per annum on their original cost. And depreciation is to be treated as a cost of sales expense. Firstly, we need to think about the journal entries that would be posted as a result of the above. Now, actually, we can do this part of the question without even thinking about the calculations. Typically, when you post depreciation, you're going to be increasing an expense, that's a debit to the expense category, and you'll be crediting the respective accumulated depreciation. So the question does reveal that depreciation should be charged to the cost of sales. So if we start off with the administrative expenses, there is no implication to this ledger because we are strictly told that depreciation will be to cost of sales. So to cost of sales, we would debit. There is no implication to the cost account for both buildings or the plant because remember, accumulated depreciation is a separate entry. Therefore, to accumulated depreciation for both buildings and the plant, we're going to be crediting. We've still got some calculations to think about for this part of the question, so let's think about a working that we might produce. So if we start with buildings and our plant, and we know that buildings are being depreciated straight line, but with plant it's reducing balance. Get down your cost number first, and we know from the trial balance, if we scroll back above, that the cost of the buildings is 740,000 and that the cost of the plant is an amount of 220,000. We've also got the accumulated depreciation, which I'll get down here. So the accumulated depreciation for buildings is 60,000 and for plant it's 110,000. That means at the beginning of the year, we have a carrying value for buildings that amounts to 680,000 and for plant that amounts to 110,000, which means our depreciation for the current year, which I'll abbreviate as CY, on our buildings, as it's based on cost, is an amount that equates to the policy that's given for our buildings. And if we scroll back down to the task, we are told that for plant, the depreciation is 20% reduced in balance, but for buildings, it's 5% on the cost, so 5% of the 740,000, which gives us 37,000. Now, for plant, on the reduced imbalance, so we take this percentage on the carrying value of this non-current asset, so 20% of the 110,000, that's going to give us an amount of 22,000. Now, actually, the question doesn't ask us for the carrying value at the end of the year, but just for completeness, we can cast down to get 643,000 for our buildings and 88,000 for plant. So at this point we can type in our answer here, simply entering that 37 because you've got the 1,000 already pre-populated, and for plant that's going to be 22. So at this point we've completed this question and we can see that we've attempted all parts of it correctly. Bringing us on to the final two tasks that remain, and in task 4 we are given information about the closing inventory. The closing inventory is valued at 75,000 and ignoring depreciation we now need to calculate what the cost of sales would be. So again we can produce a little working. So producing a working for our cost of sales, we know that we always have opening inventory. And opening inventory is presented to us in the trial balance, which we'll come on to. We always add purchases and then we deduct the closing inventory. So let's slot in that closing inventory as a reduction. We have it here in the question, and if we scroll back to our trial balance, we can see that the opening inventory is 160,000. And we can see that our purchases amount to 1,140,000. So now if we cast down to get our cost of sales, we've got 1,225,000. So we can go into our task and type in our answer. So here we're going to simply type the 1225 as the 1,000 has already been populated. Finally, moving on to task 5, we're told here that there's an invoice of $15,000 relating to energy for the quarter 30th November 20x7. Now, bear in mind that if you have a year end, that is October 20x7, and you've got the quarter to November, that implies that the quarter started on the 1st of September x7. And we're told that the invoice relating to this cost wasn't received until December 20X7, which is clearly post-year end. Now, what's quite easy to visualize in this timeline is that actually 2 months of this energy cost would therefore not have been recorded because the invoice wasn't received until after the year end. This is a typical example for an accruals adjustment. So the question does say what would be the double entry to post the adjustment for energy costs. Well, before we even come on to the calculation, we can simply identify that that would be a debit to the administrative costs. We're told the energy costs go to the admin expenses. And we can credit the accruals, which is a liability, an amount that they will need to pay in the subsequent year because the invoice was received post-year end. The amount that we're going to be posting as a year-end adjustment is going to equate to the 2/3 of the invoice balance of 15,000 because 2 months out of the 3 in that quarter is what's relevant for our year end. This gives us 10,000, so we can simply slot in here the 10,000. And there you can see that we've attempted the question and all parts of it correctly. In this question, you are being asked to identify the figure that should appear in Annie's statement of profit or loss for the year ended 30th of June 20X6 for purchases. Now, if we have a look at the detail that's been presented in this question, you're told that Annie is a sole trader and that she doesn't keep full accounting records. We've been given the details of transactions relating to both credit customers as well as suppliers, and this is for the year ended 30th of June 20X6. It's important to note that the question is asking us to derive the purchases figure, yet here we've been presented with information both for customers and suppliers. This means that some of the information provided will not be relevant for us in calculating the purchases figure. We're simply interested in the information relating to suppliers. What this means is that instantly we can disregard the information about receivables at the start of the year, any cash that's received from customers, because that's going to be to do with sales, and information about the receivables at the end of the year. We can simply ignore these numbers. The rest of the information that's provided in this question is going to be relevant for us in calculating that purchases figure. The best way to approach this question is to consider producing a T account. So let's do exactly that. Let's start by getting down the heading of this T account, which will be payables. We're going to use the payables T account and the information we have here to work backwards to get the purchases figure. Payables are a liability and therefore the balance brought forward will be a credit entry. Next in the list, we have information about cash paid to suppliers. This will reduce the balance outstanding to our suppliers, so we can put this on the debit side. We then have discounts received. Discounts received will also reduce the balance outstanding to suppliers. We'll put this on the debit side. We then have information about contras between payables and receivables. A contra entry will always reduce a payable and a receivable by the amount provided. Here the amount is 2,000. Lastly, we have information about the closing balance of the payables at year end. This will be a closing balance that's on the debit side, so that the brought forward balance will be on the credit. With all the numbers populated into this T account, it is now a case of balancing this ledger and working out the missing number for our purchases. If we total this T account, we can see that the debits are higher, equating to 391,760. We'll make that the total on both sides of this ledger. The balancing entry, in order for this T account to work, will have to represent the purchases figure that will be on the credit side, and this amounts to the difference here of 331,760. Don't forget to add that number into the solution box provided in this question.
In this question, you are being asked which two of the following errors would cause the total of the debit column and the total of the credit column of a trial balance not to agree. So here we are trying to decide which of these errors would affect the trial balance. The types of errors that affect the trial balance include the following. We have single-sided errors, where only one entry has been made. We have errors where the debit and the credit have been made at different values, and so naturally the debit and the credit column in the trial balance will not agree. We also have errors where two entries have been posted on the same side. So for example, we have two debit entries instead of a debit and a credit. There could also be errors as a result of miscasting. This could be in the ledger account or the trial balance. Another error could be where the opening balance has not been brought down. Or there could be an extraction error. This is where the ledger balance has been transferred incorrectly to the trial balance, either that the number is wrong or it's been put on the wrong side. So let's look at the four options that we have. The first one states that the rent received was included in the trial balance as a debit balance. Rent received is income, and so as a result it should be shown on the credit side. This is an example of an extraction error, and so as a result of it being put on the wrong side, our trial balance will no longer agree. Our second option states that a purchase of non-current assets was omitted from the accounting records. The debit and the credit were omitted, which means that our trial balance would have still agreed. The third option is that a check received from a customer was credited to cash and then correctly recognised in receivables. So here we've got a credit to cash, and as a result of the check being received from the customer, this would have reduced our receivables balance, and so we also have credited receivables. We can see here that we have a credit to cash and a credit to receivables, which means we have two entries posted on the same side. This will mean our trial balance will no longer agree. Our final option is that there was a transposition error which was made when entering a sales invoice into the sales daybook. This is an error of original entry. It would not lead to our debit and credit side of the trial balance no longer agreeing. And so now looking at the answers to select for this question, we can see that the first option, the rent received being included in the trial balance as a debit balance, would have led to our trial balance not agreeing, and also our third option, the check received from a customer being credited to cash and also credited to receivables. And so our first and third options are the correct answer. In this question, we are being asked to identify the total figures that should be included in the company's statement of financial position at the 31st of December 20X5. We can see from the options available that we are looking for the current assets balance and the current liabilities. We can see that we've got three options to look at in order to calculate this figure, and so I would need to set up workings for those amounts and set up a table for current assets and current liabilities so that I can capture the amounts. For the first issue we need to look at, it says that on the 1st of January 20X5, the company made a loan of $12,000 to an employee and it was repayable on the 1st of January 20X6 with interest at 2% per year. We can see that we are currently looking at the 31st of December 20X5, and so this loan was repayable straight after our year end. We can set up a working for this answer. In working 1, that the loan of $12,000 is repayable to the company straight after the year end. These are amounts due to the company and so as a result should be recognised as an asset, and so therefore our $12,000 should be put into our current assets balance. What we also have to do is include the working for interest. We are told that the interest is 2% per year. So therefore we need to take the 12,000 and multiply by 2% to work out what the annual interest was. This comes to $240, and like the repayment of the loan, it has also not been paid as yet. And so as a result, the double entry for this is to debit accrued income and to credit interest received. Accrued income is on the debit side and it belongs in current assets, and so therefore our 240 should be added to our current asset balance. In our second issue, it tells us that the company paid an annual insurance premium of $9,000 in 20X5, covering the year ended to the 31st of August 20X6. So once again, we can set up a working, and this time we should use a timeline so that we can see what's going on within the year. We can see that our year end begins on the 1st of January and ends on the 31st of December, X5. What we're also aware of is that our insurance premium ran to the 31st of August 20X6. And so therefore, this premium ran from here on the 1st of September right the way through to the 31st of August after the year end. Our insurance premium therefore straddles the year end. From the 1st of September to the end of December is 4 months, and then after the year end from the 1st of January to the end of August is the remaining 8 months. This expense has been paid, and 8 months of this expense belongs to the next year, in which case we have a prepayment. We are told that the insurance premium was $9,000, and so we need to take 8 months, so multiply by 8 over 12 to work out our prepayment. This comes to $6,000, and the double entry for that would have then been to debit our prepayment and credit our insurance expense account. Our debit to prepayments is recognised as a current asset, and so therefore this $6,000 needs to be included in my current asset balance. In the third piece of information, it tells us in January 20X6, which is just after the year end, the company received rent from a tenant of $4,000, which covered the 6 months to the 31st of December 20X5. Again, looking at this as a working, and again as a timeline, we can see with our year end, once again the 1st of January to the 31st of December X5, look, just after the year end, we have received rent from a tenant that actually belongs in the current year because it runs for the last 6 months from the 1st of July to the 31st of December. This is income received, and so we have accrued income that needs to be included in our current year. We are therefore going to debit accrued income and credit our rent received to increase our income. Accrued income is a current asset, and so therefore the total amount of $4,000 is going to be included in our current assets balance. My $4,000 can be included in current assets. We can see that there is nothing to include for current liabilities, and so if we total up my current assets, it now comes to $22,240. Looking at the alternative answers that we have, we can see that the third option is the correct answer because we have a $22,240 balance for current assets and nothing for current liabilities. In this question, we are being asked what would the net profit be after adjusting for this error. The error that they are mentioning is in the information above, which talks about an adjustment for a motor van that had been treated as an expense. It tells us that the company's statement of profit and loss for the year ended 31st of December 20X5 showed a net profit of $83,600. It was later found that $18,000 paid for the purchase of a motor van and had been debited to motor expenses. It also tells us about the depreciation rate, and so its policy is to depreciate motor vans at 25% per year using the straight line basis. It also tells us that there's a full year's charge in the year of acquisition. So the error we have is the $18,000 that was treated as a motor expense but should be capitalized. In addition to that, the other thing that we need to be careful of is that there is depreciation on motor vans. So if we have an asset, we need to make sure that there is a depreciation adjustment for this also. To correct the $18,000 in the expenses account, we are going to need to remove it from motor expenses and put it into motor vehicles cost. And so therefore our adjustment will be to debit the motor vehicles cost to recognise the asset and then to credit motor expenses to remove it from the expense account. As we are looking for what the net profit will be after adjusting for the error, we need to see what impact that will have on the profit figure. And so I'm going to set up a working. I'm going to start off with my net profit figure that was given to me in the question. So this was 83,600. I now need to adjust for the 18,000 that has now been removed from the expenses account. So this has reduced our expense account, and by reducing expenses, this will now increase my profit. So I'm therefore going to add back the 18,000. The other thing that I need to be careful of is that now we have this 18,000 sitting in our asset account, this should be subject to depreciation. So I'm going to take the 18,000 and I'm going to multiply it by 25% to show me my depreciation charge for the year. And this comes to 4,500. The adjustment for this is then going to debit my depreciation expense account and credit my accumulated depreciation, which will be in the statement of financial position. This 4,500 is now being treated as an expense, and so therefore it will impact on my adjustment to profit. So I should include it in my working. Now looking at this expense, this has been an increase to our expense account, and so therefore this will reduce my profit, and so therefore I need to deduct my depreciation charge, 4,500. Finishing off my working now, I can then look at my adjusted profit figure, and this amounts to 97,100. And so our net profit after adjusting for the error is $97,100. In this question, you are being asked to decide which of the following statements about Xenoco is correct. In order to identify the correct statement, you will need to review the individual ratios that have been given to you with the company information. The current ratio looks at the company's ability to repay its current liabilities with its current assets. And we can see that from the 20x9 results compared to the 20x8 results that they have less current assets to cover their current liabilities. We then have our receivable days ratio. This represents the average number of days that it takes the credit customers to repay the amounts that they owe the company. And so 20x9's result shows that there's an average of 75 days waiting for that money compared to 50 days from the year before. This is a substantial increase, and it's taking them longer to receive the payments from credit customers. The payable days ratio represents the number of days on average it takes them to pay their own suppliers. We can see that this has gone down from the previous year. Currently we're showing 30 days on average to repay the amounts compared to 45 days from the year before. This teamed up with the receivable days ratios suggests that there could be cash flow problems where they're waiting for so long for their credit customers to pay them, and yet they're paying their suppliers so frequently. And finally, the ratio inventory turnover represents the average number of days that they are holding their inventory before it's being sold. we can see that this year's results is showing 42 days compared to last year, which was 35 days. So they're holding on to their inventory for longer. Looking at the statements that we have to decide upon, the first one says that Xena is taking longer to pay suppliers in 20X9. We can see that this isn't true because 30 days on average in the current year compared to 45 days suggests that they have shortened the time to repay suppliers. The second statement says that Xena is suffering from a worsening liquidity position in 20X9. This looks to be correct because we can see that in 20X9 we have the result 1.2 to 1 compared to 1.5 to 1 in 20X8. Just checking the other statements, Xena is receiving cash from customers more quickly in 20X9 than in 20X8. Again, this isn't true because we can see that it's taking them longer to receive their money from customers because it was 75 days on average in 20X9 and then 50 days in 20X8. And then finally, the last statement, Xena's liquidity and working capital has improved in 20X9. Based on the results of these ratios, we can see that liquidity and working capital has not improved. In fact, the opposite has happened. And so our second option, that Xena is suffering from a worsening liquidity position in 20X9, is the correct statement based on our current ratio results. In this question, you are being asked to decide, are the following statements true or false? These are all in relation to the statement of cash flows. The first statement says that a statement of cash flows prepared using the direct method produces a different figure to net cash from operating activities from that produced if the indirect method is used. So here they are trying to examine whether you understand the difference between the two methods. The direct method and the indirect method are just different ways of disclosing this area of the statement of cash flows. The direct method requires detailed information from the accounting records, and it discloses information that would otherwise remain confidential for the company. As a result of this, it is often less popular than the indirect method. The indirect method starts with the profit figure in the financial statements, and then it makes adjustments for the non-cash items, removing those items that are not cash related in order to reach the net cash from operating activities. Both of these methods will give you the net cash flow from operating activities. This will not be a different amount using the direct method to the indirect method, and so therefore this statement is false. The next statement says that the rights issue of shares do not feature in a statement of cash flows. A rights issue is an issue of shares to existing shareholders. The offered share price is often less than the market value, but cash does change hands. There will be a cash flow as a result of that transaction. And so therefore, again, this statement is false. The next statement says that a surplus on revaluation of a non-current asset will not appear as an item in the statement of cash flows. So here we need to decide, is a surplus on revaluation cash or not cash? If an asset has been revalued, and let's say it's a surplus, it means the asset's going to go up. So they would debit the asset account and then they would credit the revaluation reserve. No cash has changed hands, and so as a result it is true that this will not be an item on the statement of cash flows. Finally, the last statement says that a profit on the sale of a non-current asset will appear as an item under cash flows from investing activities in the statement of cash flows. Our profit figure does not equate to cash. When looking at a disposal of a non-current asset, in that transaction, the cash element is the proceeds. If you were using the indirect method, there would be an adjustment for the profit figure because it is a non-cash item. However, in the area cash flows from investing activities, we would put the proceeds figure in instead of the profit figure. And so therefore this statement is false.
In this question, you are being asked to calculate the depreciation charge for the year ended 31st December 20x5. You've been presented with a T account for the plant and machinery at cost ledger. The information contained in this T account will be very useful in helping us to work out the depreciation. Particularly important in this question will be the dates. We have a final sentence that reveals the company's depreciation policy, which is 20% straight line, and that's proportionate depreciation in the years of purchase and disposal. I think the best way to deal with this type of question is to firstly visualize a timeline. So let's do precisely that. We're told that the year end is December, so the beginning of the year will be January, with the end of the year being December. The information in the T account reveals that on 31st of March, there was a disposal of an asset. So if I mark that up in my timeline, 31st of March, they have a disposal. Because the depreciation policy is proportionate in the years of purchase and disposal, we can establish that for at least 3 months of this year, the asset that is disposed of would have been depreciated. Thereafter, they've sold it on, so no depreciation is relevant for the later 9 months of the year. We can also see that on the 30th of June, they made a purchase of an asset, and that would be an addition to the business. So if I mark up 30th of June on my timeline and label it up as an addition, what I can clearly see from my timeline is that based on this policy of prorating for the years of purchase and disposal, that only 6 months worth of depreciation would be charged for this asset, and that is from the period June onwards when they've acquired this asset. For the remainder of the assets in the business, a full year's depreciation would be charged. Armed with this information from our timeline, let's produce a working to help us calculate the charge for the year. I'm going to start off by thinking about the additions for the year. We can see from the timeline that the additions made have a value of 160,000. With a depreciation policy of 20% and a timeline revealing that only 6 months worth of depreciation should be charged, we can identify that 160,000 multiplied by 20% multiplied by 6 months of the year gives us 16,000 for the additions. Next, we can deal with disposals. Looking at the T account, we can identify that for disposals, the cost of the assets disposed of was 60,000. Again, the policy of 20% applies, but this time we're charging only 3 months of depreciation on the assets disposed of. So taking 60,000 multiplied by 20% prorated for 3 months of the year gives us 3,000. Lastly, we can deal with the assets remaining. Now, be very careful here because with the assets remaining, yes, we've got 240,000 as the opening balance, but included within that number would have been the assets of 60,000 that have been disposed of. We do not want to depreciate them again. Remember, they were disposed of partway through the year. So what we need to do with the depreciation on the assets remaining is to take 240,000, remove the 60,000 assets disposed and multiply that by 20% because depreciation needs to be charged for the full year. There is no prorating required. Multiply this out, we get 36,000, and if we cast down, we have a total depreciation of 55,000 that should be charged to the statement of profit or loss. In this particular question, the option that reveals that is option B, or the second option. In this question, you are being asked to identify the rental income that should appear in the company's statement of profit or loss for the year ended 30th of April X6. The detail of the question reveals that the company receives rent from a large number of properties and that the total they received in the year 30th of April 20X6 amounts to 481,200. You're also presented with information about the rent received in advance and in arrears for 30th of April X5 and X6. Be aware that the rent received in advance is often referred to as deferred income. This is simply amounts that have been received for a particular year but actually relate to the following year, hence they need to be deferred. Rent in arrears is often referred to as accrued income. This is income that is outstanding at the end of a particular year. You're presented with information for X5 and X6. The balances given for X5 will be the opening balances or the brought forward figures, and the balances given at X6 are the closing or the carry forward figures. The best way to approach a question like this is the shortcut formula approach, which I'm going to show you. Start with the opening deferred income. The question reveals that the opening deferred income balance is 28,700. We're going to add that figure on. We're adding this figure on because it's an amount that would have been deferred last year. It would have been deducted from last year's rental income, but it is relevant for our current year. So we're adding on the deferred income. The next thing we're going to do is we're going to deduct the opening accrued income. The opening accrued income would represent a balance that was outstanding at the end of last year because it was income that was truly earned in the previous year. It would have been added last year, but this year it's not relevant for our numbers. We're going to be deducting that accrued income, and that is the 21,200. Next, we're going to be adding the cash that has been received from the rental of the properties during the year. This is information that was given in the very first sentence of this question, the 481,200. Next, we're going to deal with the closing balances of deferred and accrued income, starting with the closing deferred income. Now, closing deferred income needs to be deducted. It relates to next year. We're going to remove it from the balance of the rental income that we show in our current year. Next, and finally for this question, we deal with the closing accrued income, the 18,400. This represents amounts that are outstanding for the current year and should be included in the rental income balance for the current year. And if we add down, what we will get is 475,900. This is the rental income that the company must show in its statement of profit or loss for the year ended April X6, which is option D in this question. In this question, we are being asked to identify the company's capital structure as at 31st December 20x5. In other words, we need to calculate the balance for the ordinary share capital and the share premium account at year end. In the question, we're presented with information about the capital structure at the start of the year. This reveals that the ordinary share capital balance is 125,000 and the share premium account is 100,000. We also have information about the nominal value for a single share, which is 25 cents, and we've also got information about the total number of shares that the business has at the start of the year, and this is 500,000. We learn that the company has made a rights issue of 1 share for every 2 held at £1 per share, which was fully taken up. And later on, this was followed by a bonus issue of 1 share for every 5 held, utilising the share premium account for this purpose. Now, in order to answer a question like this, we need to work out the number of shares that were given on the rights issue and the bonus issue. So let's produce a working thinking about the chronological order of events that have taken place. So we'll start with the opening number of shares that the business has. Next, we know that a rights issue takes place. The rights is made at 1 share for every 2 held. So this means we can work out the number of shares on the rights issue by simply taking 500,000 dividing this by 2 and multiplying it by 1. This would give us 250,000 shares that are given on the rights. Now we know that the rights is made at a monetary amount of $1 per share, giving us a total amount of $250,000. Now, yes, this would be the cash that the company receives. However, when it comes to entries posted in the share capital and share premium account, the posting to the share capital account will only be for the nominal value. So we can split this amount between the share capital and the share premium. The share capital entry will be for the number of shares on the rights, the 250,000, multiplied by 25 cents, the nominal value for a single share, giving us $62,500. The balancing amount would be to share premium, and that's going to be the $187,500. Next, we want to add down the number of shares to get the cumulative total before we work out the bonus issue. So here we've got 750,000 shares, and now we can work out the number of shares given on the bonus issue. The bonus issue is made at 1 share for every 5 held. So we can take 750,000, divide this by 5, multiplied by 1 to give us 150,000 shares, which would have been given on the bonus. Now, a bonus issue is always made at the nominal value being 25 cents. So the total amount here would be 37,500. This would certainly increase the share capital, and we are told that it is funded out of the share premium, so it would reduce the share premium by the same amount. Now, having calculated these amounts, we can simply work out now the total balance for our share capital and share premium at year end. So if we start off with the 125,000 in share capital, add on the amount that is generated from the rights issue, which we calculated as 62,500, and we add on the amount that is going to be increasing the share capital because of the bonus, which is the 37,500. That gives us a closing share capital balance of $225,000. For share premium, we know that as a result of the rights issue, there is an amount of 187,500 that increases the share premium account balance, but the bonus would be a reduction of the 37,500 because it's funded out of the share premium account, and what that gives us is 250,000. We can see that from the options presented, that is option number 3 as the correct answer.